From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for the last Friday in January. Let's see what's happening. The award-winning Hamilton is at the Marcus PAC through Sunday, and then there's the Ice Bear Fest. You heard right, the Ice Bear Fest. Milwaukee's famous après-ski dance party meets a beer festival. It returns for its 8th year at Third Space Brewing. Or if you don't have enough baseball, football, or basketball trading cards, this is for you. It's the biggest card show of the year, and it's happening this weekend at the Baird Center. Hey, we're all familiar with FEMA these days, aren't we? Well, the Federal Emergency Management Agency is no longer permitted to say during winter storms, watch out for ice. And no, I didn't make that up. Melania Trump's new movie premieres this weekend, and Variety magazine has already released a scorching review. It reads, "If you show this on an airplane, people would still walk out." Speaking of airplanes, a gate attendant at the Atlanta airport made his announcement in preparation for a flight to Paris. Folks, just a reminder, Paris, our destination, is international. That means outside of the United States. I'm glad he explained that. On the podcast today, we have Kendall Bauer, Mike Helsel, Joel Driesing, and wrapping up the week, here's Kyle Tedding.
Well, thanks, Max. A mixed week overall for stocks. NASDAQ down 0.2%. That's down 39 points on the week. The S&P, though, up 0.3, added 23 points. And the Dow Jones Industrial Average down 0.4% on the week, down 206 after losing 179 on Friday. S&P finished at 69.39 on the week. That's up 1.4% for the year. Dow up 1.7, and the NASDAQ up 0.9. A quick look at the week. You know, Kendall, a great kind of high water mark for the S&P. We hit 7,000. Couldn't quite hang on to it in the close on Tuesday, but we saw a new record, which has tended to be a decent sign for investors that there's some optimism overall in the market. And yet, then we had the Fed really come into focus for the rest of the week. Stocks come back down to earth a little bit, but we still finished the week positive overall for the S&P. Happy overall sign, perhaps, despite the fact that, you know, it wasn't positive numbers all over the place. What are you looking at right now? What are you seeing? What are you talking to clients about?
Yeah, I think always fun when you break through a big barrier, a big number like the 7,000 on the S&P. But no, I think still a good reminder that even with all the things going on, you know, domestically, geopolitically, to be concerned about, there's still certainly some positives to keep our eye on the ball this year. Notably, fundamentally, earnings forecasts, which we'll get into maybe in a little bit. But not all doom and gloom out there.
No, I think that's fair. And, Mike, it was certainly Jay Powell and the Fed that were the star of the show midweek. Perhaps the president in nominating or potentially nominating, pointing to a nomination of a new Federal Reserve chair stole some of the Fed's thunder earlier in the week. But we didn't learn much from the Fed beyond what we already knew, namely that the economy is somewhat strong, that we've been surprised by better than expected economic growth, and that we have seen some softening of the labor market, although it's stabilized. It led the Fed to decide, you know, we don't need to really make any cuts here. And then we got an announcement, at least I'm not even sure how to frame it, but some semblance of an announcement on Friday that we'd have a Fed governor potentially named here or nominated here in short order, a former Fed governor to the Fed chair position now by the name of Kevin Warsh.
Yeah, it was really nice just to have a boring meeting because, let's be honest, folks, sometimes boring is good, right? Just to say, hey, everything's stable. You know, we don't have any big highs, big lows right now. Things are just kind of holding on. And I believe you said his name wrong. It was Kevin Warsh. Shout out to the late, great Catherine O'Hara, who passed away today. If anyone's listening, go watch Home Alone or Schitt's Creek tonight. You'll get a good laugh.
You folded that in really nicely, Mike.
Thank you very much. But yeah, it was. So I thought the most interesting part was the nomination, right? He's of Kevin Warsh. I'm not going to scream again; my vocal cords will go out. But you said he got Jamie Dimon. Forever, what you think of him? He seems to really like him. He was on the board before. I think the most interesting thing going forward with him is, I should say a couple things. One, how much independence is he going to have from the president? Because that's a big talking point on Wall Street right now. Is he going to be independent, or is he just going to kind of rubber stamp what the president wants? Now, I always remind clients who bring that up to me is he's just one guy. They have to get the whole board to vote, so people shouldn't necessarily freak out about one guy wanting to do certain things because you need a majority of people to do that. And the other part is, now it's very early. He just got nominated, so there's a long way to go. But right now, you're already seeing some pushback from a couple, like at least one Republican senator and a couple others kind of in the shadows, that they may not vote to confirm him unless the lawsuit against Jerome Powell goes away. Now, this is kind of uncharted territory for a lot of people, so I'm very curious to see where it goes. But right now, one senator in particular, Tom Tillis of North Carolina, has said he's not going to support him at all if this lawsuit doesn't go away. And that one vote alone could be enough to sink him. So I think we are into, and again, we, as you mentioned, we have a little bit ways to go, but it's going to be an interesting kind of ride to see where this plays out with him, because if Tom Tillis, who, by the way, is not up for re-election, so he can be a thorn in the side completely. And if he's not, then Jerome Powell remains as president until a new president is confirmed. So that's the main thing I'm watching with this, is to see where does all this go.
I also think it's interesting. I don't think that Jerome Powell's term on the Fed board expires with his presidency.
It does not.
So there's a question of whether he's going to stay on the board and be one of those 12 votes on that FOMC committee, or whether he's going to leave when he, loses the
rumors.
chair.
Yeah, the rumors are already there that he's going to stick around, almost out of spite, which I think is kind of hilarious, to be honest with you. But yeah, that's the big rumor, that he can still be a board member, just not the president, and he can stick around.
And a voting board member.
Yes, absolutely.
We should be clear that the Federal Reserve is not ruled by fiat. It's not ruled by King. It's not ruled by some sole voice. While Jay Powell is the chair of the Fed, certainly has been the one that comes out and gives messaging around what the Fed is doing, what they're talking about inside their meetings. It is not strictly Jay Powell that has made the choice to raise, lower, or hold interest rates steady. Again, this week did get the news that we would hold rates steady for the first time in a Fed meeting since July. But it is a voting body that ultimately makes these decisions. And so Jay Powell's voice is going to be nearly as powerful, not as chair, but as just another voting member, if only because it's one vote, and still one vote even when Powell's not chair anymore. And I think when you look at the Federal Reserve and the role they play more broadly, the importance of the independence, it is those votes ultimately that help to maintain that independence, because it helps to spread out the nominees, it helps to spread out turnover in the Fed, such that you don't have any one party, any one politician who can usually put undue influence upon those members. And I think Powell would be wise to stick around to ensure that the Federal Reserve's path that they have so clearly laid out for us, this commitment to sticking to the data, is the path that they continue down.
And Kyle, one of the things that you didn't mention when you mentioned that the Fed, talked about the unemployment, the inflation, the strength of the economy, is that they also said uncertainty is elevated. So, and that's the reason why they're still undecided, and they're still going to be watching the data to see what their next move is.
Yeah, and uncertainty is fun, because one of Powell's comments was that the economy has once again surprised us with its strength, not the first time. It speaks to that uncertainty, right? That we can often be surprised about the direction things are headed or have headed. In this case, we were surprised to the upside, and those are the good surprises. But the other side is we are uncertain about the future as it relates to inflation, as it relates to the labor markets, and just the economic activity more broadly. And with that in mind, again, the Federal Reserve is so critically focused on the data and that really should be where they are. It's one of the reasons why, at least at the outset, I'm encouraged by the nomination of Warsh. Although he has been a critic recently of the Federal Reserve, he at least understands the process. He understands the importance of the role the Fed plays, and most importantly, understands what is the Fed really looking at? What are they trying to do? It's not like he's going to need to learn the foundational principles at the Fed. He understands the dual mandate as well as anyone. He understands the role the Fed plays. Yeah, he may have an opinion one way or the other on should we cut more, should we cut less, should we raise rates. That differs a little from the current consensus, but at the end of the day, he is at least part of the body, the historical body of the Fed.
And it was nice to see that this headline didn't really move markets, because quite honestly, it shouldn't. It was, I know a lot of times markets lately, big swings on certain headlines. It was nice to see that just a simple nomination of a Fed president did one way or the other, right? No one got too elated. No one got, too down, because again, let's be honest, these are people that they're data nerds that just crunch numbers and then do the best they can. So it shouldn't move markets. And I was pleasantly surprised to see that it didn't move them one way or another in big swings.
Yeah, I think that's very fair. This shouldn't even be news, really, other than, hey, we've got a new chair potentially coming in, but it shouldn't really change the path all that much. And when you look at the futures markets, not really any change to expectations for where rates are going to go this year prior to the announcement. Even looking a week back prior to Powell speaking on Wednesday, yeah, we expected somewhere between 1 and 3 cuts this year, with kind of the median, the most likely outcome being that we'd get 2 cuts, at least based on how the futures markets are pricing it. And sure enough, despite some potential for change at the Fed, nothing really changed in terms of those expectations. That, I think, is a pretty comforting fact for those of us who want the Fed to continue to maintain that independence, want the Fed to continue to push toward how can we evolve along with the data. Kendall, you had pointed out an article to me from somebody you and I both read regularly in the Wall Street Journal, Jason Zweig, pointing out a comment we are getting more and more from clients on how do we access this broad array of investment opportunities that aren't otherwise publicly available, thinking of pre-IPO or pre-initial public offering stocks or private equity, whatever that looks like. And Zweig, I think, rightfully putting a word of caution out for those investors who maybe don't fully understand what it is they're getting.
A man of the people, Mr. Zweig. I think it was perfectly timed. There was a few announcements this week about chatter around the potential for OpenAI, SpaceX, and I think Anthropic, and another big player in the AI industry, potentially going public this year. And so that brings up this question that we get time to time from clients or is talked about pretty regularly in media around private equity. So getting into stocks that aren't yet made to the public. It's kind of like this area people get excited about because it's hard to get. One of those things. It's the fancy sports car that you think about and dream about, and then you get and then realize that there's thousands of dollars of maintenance and upkeep and other things involved that no one ever told you about or that you didn't realize. So he did a great job pointing out some of the hurdles and pitfalls and traps that can catch the average day investor, or the average investor, who is trying to get access to these things. It's still quite difficult even to do that. You often have to be what's called an accredited investor. So there's different requirements to meet that. Oftentimes you have to have more than $1 million, certain amount of income thresholds to even qualify to buy into some of these companies. Furthermore, it has to be done through what's called a special purpose vehicle, or an SVP, which is just a fancy term for a pool of investor money that's used to buy these shares. So sometimes you, the investor, you don't even own the individual shares. You own a portion of a pool, that owns those shares. And with that SPV, or that pool of investors, there's these embedded fees that sometimes you're paying up front, sometimes they're ongoing. And so there's just layers to this stuff that oftentimes gets thrown out because maybe it's had a good run, or it's that thing that you want just because you can't have. And so excellent piece by Jason. Recommend reading it. I don't know if you've read it or you had thoughts on it.
Yeah, I think it's interesting, especially when we look at something like SpaceX, right? This access to public space exploration instead of the government-funded space exploration. And when you look at what Musk has been able to do, when you look at the future potential earnings from a business like Starlink, they're all reasons to be excited about space exploration overall. And yet I don't want to have to wait for the planets to align in order to get my shares of SpaceX. And so I understand the appeal, but I think we have to urge that caution because these businesses are private for a reason. They are not going through the same audited financial process that so many publicly traded companies are. They do not have the same disclosure requirements. And it's why going way, way back to some of the early securities acts, the rules were created to carve out those kinds of investments only to those individuals, A, who had the financial wherewithal to take on that risk, but B, who in theory had the financial sophistication that accredited an investor title that really is necessary for so many of those direct investments. It really was a way to say, well, we think that you are financially savvy enough to make your own decision. You don't need an analyst. You don't need financial audits of these companies' financials. And more importantly, we think you can take this risk because you make enough money. And so I think that caution alone is generally enough to want to stay away from a lot of those businesses. But I understand the appeal. And there are other ways to get that kind of exposure, whether it's through the supply chain of those types of businesses, whether it's through more publicly traded vehicles that do have some exposure, that maybe chasing them just for the sake of chasing them doesn't make a lot of sense.
Or waiting for them to go public.
Precisely.
And also, too, I mean, the liquidity piece of it is a real thing to consider. Oftentimes, that money's tied up for sometimes long periods of time. And there's no guarantee that these companies are going to go public. So there's this idea of, well, if I can get into SpaceX, it's going to go public, it's going to 10x, I'm going to make all this money. Well, there's no guarantee that just because even if you go through these hurdles and meet this criteria and get ownership in it, there's still no guarantee that it does go public. And even if it does go public, there's no guarantee that it's going to skyrocket in value. I mean, there's plenty of examples of companies that have gone public and gone the opposite direction, so much so that they had to be taken private again. And in other scenarios. So excellent read. It's something that we hear more and more. And sometimes it gets thrown out as just like blanket advice, which drives me nuts. I think drives a lot of us nuts here that, everybody should have this thing. It's like, well, wait a second and make sure you understand what it is that you're trying to get.
For the right investor and for the right purpose, right? That you understand what it is you have and that you understand the role it plays. Joel, we talked a lot about the Federal Reserve and kind of their focus on the economic data. We got a good bit of economic data this week. Anything in particular stand out to you?
One of the things, getting back to the Fed's decision, one of the Fed governors who voted against keeping rates the same was Christopher Waller, who actually wanted to cut rates again, as they did the last 3 times. And an interesting argument that I read from him was that the tariff effects actually, if you took those out of the equation, that the inflation rate right now would still be around 2%, which is what the Fed's target is. And one of their reasons to be cautious is because they want to bring that down. The general inflation rate is more like 3%. We had numbers this week on the wholesale inflation rate, and it was 3.5% year to year. It was 3% from last December. So Christopher Waller says, take that out and the tariff effects, and that would sort of even things out and take away the argument about being cautious about inflation. So I bring that up because that gets to the whole level of uncertainty that Chairman Powell raised, because we're still uncertain what's going on with the tariffs and how that's going to pan out with the economy and all the things that we're looking at. And this week we had numbers on the trade deficit, and the trade deficit basically doubled in size between October and November, to show how volatile that number is. And remember, a trade deficit takes away from economic expansion, from the gross domestic product. So when we had a doubling of the size of the trade deficit, that's just another reminder of these tariffs that are still uncertain out there that are probably going to be changed by whims occasionally with different countries
Sometimes daily.
throughout the next 3 or 4 years at least. That's an uncertainty that still enters the economy.
And that uncertainty is weighing on consumer confidence, right? It's weighing on how consumers feel about what's going on around them.
Right. And even though we have a lot of other numbers, and the Fed itself said that the economy is still, having a solid expansion, we had numbers from the Conference Board that consumer confidence is now the lowest it's been since 2014. Think of that. I mean, even outside of the pandemic, it's now lower than that, and it's across demographics. It's regardless of age, it's regardless of income, it's regardless of political affiliation.
And maybe I feel great, but there's a lot of stuff going on out there that you do have to take in and go, all right, well, how is the world changing? How's it going to impact me, not just today, but looking out 6 months, a year, 18 months? And, I think when we look at the sentiment numbers, the confidence numbers, it's showing up. And then you add in the housing part of this conversation. We had some data this week on what home sales look like.
That's actually a little more encouraging maybe, because it's finding that for the, fourth or fifth month in a row, that housing prices, that the increase is running lower than the overall inflation rate. So maybe that's going to help bring down the overall inflation rate. And if that happens, maybe consumer confidence will increase and people will be spending more, and that will help economic growth. And the whole consumer confidence thing is with the caveat that we keep repeating, that although confidence is low relatively, that people keep spending money, and that's all the economy really needs, is for consumers to spend money.
We throw out the 70% of our economic activity that comes from consumer spending, and it continues to amaze that despite all of the indicators that should suggest that consumers are a little bit tighter with their pocketbooks, they are spending. And the Fed is talking about the strength of the economy overall. You've got broader measures that show, things are still humming along. Yeah, maybe not as fast as it could, but fast enough.
And one of those things that's humming along or looking more positive is something that you point to a lot as far as your hope for the future, and that was worker productivity. And we had an update on numbers for the third quarter, and the number didn't change. It was 4.9% increase on an annual rate in worker productivity. And basically that's telling us that the output of our economy is still growing, and it's growing a lot faster than the number of hours worked. So even though the labor market is weakening, and it's weaker than it's been, we're still, as an economy, churning out products.
Yeah, an important reminder that you grow your economy one of two ways. You get more workers. Well, we certainly aren't doing that. We've got far more people entering the ranks of retirees than we do entering the workforce. Or you make the workers that you have more productive, and if the way we're going to grow our economy into the future is through worker productivity, that's going to rely significantly on capital expenditures, property, plant, and equipment, things like these AI data centers that are really geared toward how do we make the workforce more efficient into the future. And so encouraging to see those kinds of numbers, encouraging to see how it can continue to drive not just economic activity, but also corporate profitability into the future, makes its way into our portfolio as shareholders of these underlying businesses. And so it's one of the reasons why I continue to be very encouraged about the direction overall that we're headed. Well, we enjoy doing the program for you. Thanks for listening. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.